In this week's tutorial, we're going to look at two standards that we've covered in class, IAS 2 inventories and IAS 41 agriculture. So I've picked a couple of smaller questions. One of them is a past exam question, just to get a sense of how these areas might come up. And of course, you have a detailed question pack up on your Loop page as well to help you cover this. And you'll start to see when I release exam papers in 2 or 3 weeks' time, these types of issues typically come up as part of a bigger question. And your exam this year will, of course, will be a big IAS 1 question and either ratios or cash flows. You're more than likely going to be asked, for example, journal entries or maybe discuss the key principles if an IAS 2 or an IAS 41 area comes up. So this question 1, was a past exam question from 2019. Now notice it was a 20 marker. The exam paper was different that year because, of course, it was a closed book exam in an exam hall. It'll be slightly different this year, but we'll talk you through it. And you're given 4 different requirements. In accounting, what are generally considered the 3 main categories of inventories? A definition of the measurement of inventories, that's your second requirement, and then the name of the accounting standard that deals with inventories. Now, of course, you wouldn't get that in an open book exam because it's straight out of the slides, but it's no harm knowing the key issues, because if you did get an IAS 2 issue in an exam in May, you might be asked to give journal entries and back it up by citing the rules and citing the standard. So you certainly still need to know the theory. So I might ask you to do an IAS 2 adjustment. You'll need to know the journals, but you'll also need to give your rationale of why you're giving that journal and referencing the appropriate standard. What is the definition of a biological asset? Part B. Give one example and give the accounting standard that deals with biological assets. So again, more theory aspects in that August exam. Give the journal entries for area 1, and we'll look through that. And finally, give the journal entries to account for area 4 at the end of 2018 as well. So 20 marks in total. So if we start off, we'll put these side by side to do the answer. So we start off with the basics of question 1. First thing we're looking at is part A. Now again, these are really theory based, are more suited towards a closed book exam as they had in August 2019, but we'll look at them. What are the 3 categories of inventory? Again, this material is coming straight from your slides. 3 categories of inventory, which is covered there in slide 6. Raw materials, work in progress, and finished goods. That's what they were looking for there, is those 3 categories. So again, it doesn't take too much in terms of, I'll just type them in, raw materials, work in progress, and finished goods. That's your answer to that initial part. So there's multiple requirements here. What are the 3 main categories of inventory? If you're a manufacturer, you would have all 3. If you're a retailer, you would only have finished goods. The measurement of inventory is the lower of cost and NRV, which stands for net realizable value. Net realizable value. So it's the lower of cost and NRV. So you have to figure out what the cost was, and then you have to figure out, well, what can I sell it for today, which is your NRV. And of course, the accounting standard, IAS 2 inventories. So more likely, if IAS 2 came up in the May 2021 exam, you'd be given a little adjustment to a trial balance question. Maybe it's lower of cost and NRV adjustment, but you'd have to explain what the adjustment you're making. So you'll be doing journals, you'll be asked for journals, but you'll also be asked to explain with reference to the standard why you're making that adjustment. So this knowledge is important, that you still know your theory, you know the key rules and concepts in the standards, because you're going to have to apply them on the day of the exam. What is the general definition for a biological asset? We're now going on to the agriculture side. So again, if we come down, this is in your slides as well, so you do need to know them. But remember, it is going to be an open book exam for this year. So what's a biological asset? Right. So we can come down here, it gives us a definition. So you get examples of biological assets, sheep, trees, which are asked for as well. So you can use that here. So it involves the transformation, growth, generation of particular assets. I mean, that's a longer-winded way. The main one we're using is here, is a living animal or plant. That's what a biological asset is, and that's what they're looking for here. So under this particular standard, a biological asset is a living animal or plant. And they'd accept that as an answer. And of course, the relevant standard is IAS 41 agriculture. So that's your key requirement in terms of Part B. The example might be, for example, you could say cattle, you could say sheep, etc. are all biological assets. Right? So that's a nice simple one, but again, you wouldn't get that generic question now in an open book exam, but you might be asked how to value them, how to account for them, and you'll be referencing back to IAS 41, and you'll be referencing back what is cattle or sheep in an accounting sense. It's a biological asset. So again, these are basic things that are important. You have your core knowledge of the slide deck and the content of those as well. So let's look at Part C, which is provide the journal entries for Area 1 for 31st December 2018. So we're told Ashtown grows and supplies timber in all of Ireland. And they're engaging in particularly IFRS. They want your services as a consultant. So their main biological asset is Area 1. It's a forest in the Midlands. It's in last year's, be careful with the date, last year's statement of financial position of 100 grand. And no adjustments have been made to reflect the 2018 changes. At the end of 2018, the estimate the forest is now worth 150,000 at selling cost of 5,000. So the question is, how do we value biological assets under IAS 41? And if we come back here in terms of the accounting, biological assets, this is slide 43 in your notes on Loop, is fair value less cost to sell. So you're always measuring them at the fair value less cost to sell. So if we come back here to the question, the fair value less cost to sell at the end of this year is 145. Fair value less cost to sell, 31st of the 12th, 2018, is 150,000 minus 5,000, which is 145,000. So that is an increase of 45,000 over 2017 fair value less cost to sell. So this is the rules in IAS 41. You always measure at fair value less cost to sell, because there's a big difficulty in measuring, for example, biological assets at cost, because a lot of them didn't cost anything. They might have been sown from seed, in the case of forest. They might have been born on the farm, in the case of animals. So it would be here debit biological asset, which is your forest, 45,000. It's not debit the 145, because remember, it's already in the account at 100,000. You're only recognizing the increase. And you will credit the SOPL, fair value gain, 45,000. So under IAS 41, you will credit the statement of profit and loss, directly the gain. You have to take off the cost to sell. So the 5,000 must be taken off, and that will be, it'll be recognized in at 145. So your biological asset is now 145 in the statement of financial position. Most likely it's going to be there in non-current asset. I'll put that up there. It's going to be in CA, in the SOFP, and then your gain goes to the P&L. Either goes to other income, or if 45,000 is material, then it would have a separate line item under IAS 1. So it's not a bad journal entry. That could be a journal entry as part of a bigger question 1 where you're doing trial balance of financial statements. But you have to know your basic knowledge of each of the standards. There could be a lot of standards covered in an IAS 1 question in an exam scenario. Part D then is asking us to account for Area 4, which we're told on September 2018 it cut down another forest. So this is the harvesting now, which is an important aspect in IAS 41 as well. The fair value less cost to sell at the date of harvest was 200,000, not including selling costs of 7,000. All right. The company was able to sell sawdust for cutting down the trees for 2,000. So that's a particular thing we call it in the IAS2. And we'll come to that again. And at the year end, the market value of the timber is 210,000. No adjustments have been made in the 2018 accounts. Area 4, like Area 1, is still recognised at its carrying value from last year, which was 160. Now, this is a particular rule of where IAS 41 and IAS 2 integrate. At the point of harvest, as your note 43 says, The point of harvest represents the transition between IAS 41 and IAS 2. So at the point of harvest, you determine the fair value less cost to sell, and you revalue that biological asset. Once the harvest is over then, that value turns into, in inverted commas, the cost for IAS 2. So once you harvest something, once it goes from a forest into timber, it changes from biological asset into inventory. And that's an important distinction. So number one, you fair value the biological asset at harvest. So in our case here, it's going to be a fair value gain of, be careful, 193,000, which is 200 minus 7, versus 160, which is 33,000. So you've made a fair value gain there just before the harvest of 33,000. It's gone from 160 up to, be careful, 193, 200 minus 7. So you'll do the exact same as we've done above. You will debit the biological asset 33, and you will credit the fair value gain in the SOPL 33. That's your first step when there's a harvest. Second step now, after harvest, the asset becomes inventory. So after the harvest, this asset becomes inventory. You're going to credit the biological asset to get rid of it. Be careful, you're going to credit it at 193 because that's what's going to be in the accounts at. It was at 160. In September, you brought it up to 193, and now in September, you're changing that over to inventory. Credit the biological at 193, debit, in this case, inventory 193. Right, that's our next step. So that's the transition from IAS 41 to IAS 2. And these are the types of things we expect you to be able to say. You're going to say transition from IAS 41 to IAS 2 at harvest. But that's the little, because I will be asking you to articulate why you're doing this particular treatment in an exam scenario. The other thing, what about the 210,000 at the year end? Do not revalue the timber at 31st of the 12th, 2018 as cost, which in this case is the 193, is lower than NRV, which is the 210. So remember, we're now using IAS 2. Once the harvest is over, it's IAS 2 rules that are relevant. And we know we measure inventory at the lower of cost in NRV. So that means the implied cost here is what we transferred it at. So you're leaving it at 193. But you have to articulate that because otherwise we don't know whether you've left it out or not. And the last thing then is, what about this 2000 here? Sell the sawdust generated from cutting trees at 2000. Now this sawdust is what we call a byproduct. Sawdust would be seen as a byproduct under IAS 2 because it's a small little byproduct. It's not material. It's only 2,000 in cash. And if you go to your slides and we go down and we see, can we talk about the, sorry, up here. Easiest one is to, we'll find it here. Put in a hyphen. So byproducts, this is slide 26. If a byproduct is produced that is insignificant value when compared to the main product, which we have, because the byproduct is only 2,000 compared to 200,000, so it's 1%, so it's insignificant really. The sale proceeds from the byproduct are deducted from the cost of the inventory, rather than recognizing separate revenue. Now that was an exam level trick to see, did students, were they aware of the key detail in IAS2, not just the basics of IAS2, but the detail as well. So here you're going to debit bank or cash. I think it said cash here, 2,000 to bring the money in. So it actually said cash, so I'll just put cash. And you're going to credit inventory. Say inventory cost 2,000 less. Reduce your inventory down. That's only allowed because under byproduct, and have a look at the slides there as well, you reduce the cost of the inventory if the byproduct is insignificant. Now that's a tricky one to see that you have your knowledge there. So there's a couple of tricky bits, particularly in that area 4. Number 1, did you know to get the fair value of it just before the point of harvest? Then you transfer it into inventory. And then remember at the year end, you apply your inventory rules, the lower of cost to net realizable value. In this case, you wouldn't revalue it upwards because the lower is the cost. So it's fine to be left at the 193. And the final little tricky bit there was, of course, the byproduct. And you net that off against the cost of the inventory. And so that was a past exam question from AC 220 from the August 2019 paper. So the next question we're looking at now is going to be question 2. So again, if you haven't paused this, have a read through it and even make an attempt at some of it, just to see how you get on. So we'll look at question 2 here now. And we're going to look at part A. So you're told here, explain with reference to the appropriate accounting standards, based on the information above, how the corn should be measured in the financial statements at the end of 2018 and in March 2019. And then part B is give the journal entries to correctly record the corn in the financial statements at the following dates. So how should it be measured? And then give the journal entries. So 2 separate items. Now they're very much linked together, but we'll do them separately given that it's asked. So we look at initially here. During 2018, they planted a crop of corn. At the end of 18, the crop was not ready to harvest. No active market exists. And at the end of 18, based on information available, they estimate the crop would eventually realize a gross value of 120 million at auction. So it's a substantial amount of corn. The amount is calculated taking account of the time value of money. At the end of March, the crop was harvested, and on that date, the sales value had dropped to 110 million. Because, of course, this is a commodity, the prices go up or down. Auction house costs are 2% of the gross sales price at the point of sale. All right, so we have things to consider here then. First one is what's the relevant standard? Well, we know here the relevant standard in the case of the corn, IAS 41, right? This is, if you want to put it down, corn, to justify it, is a biological asset. So again, you're just showing the examiner, I know the relevant standard, and I know why it's IAS 41. So you're looking there, we need to figure out what's the measurement we should measure at the 31st December and the 31st of March. Well, at 31st to 12th, 2018, corn should be measured at fair value less cost to sell. Fair value less costs to sell, which is FVLCTS. So you should measure it at the fair value less cost to sell. So that is important that you understand exactly where it's coming from. And they tell you here that the fair value less cost to sell is 120 million. Now they do say no active market exists, but you have to put some figure on it, and they do give you information accounting for time value of money. The best way to do this is to use the 120 million, which is the present value. So that's the more accurate one. And in that case, you should also be careful. It's not the 120 million overall. It's 120 million times 98%, right? Because you have to take account of the auction fee costs as well, because they're 2%. So even if you were going to sell this, you wouldn't get the full 120. You'd only get 0.98, which is 117.6 million. That's how much you should measure it at the end of 2018. Right, so that's important. It's the fair value, which is the 120, the gross sales value, less the cost to sell, which you're told here is 2%. The fact that we're taking a percentage means that'll already account for the time value of money as well, because it's percent of a present value, which is fine. Right? In the 31st of the 3rd, 2019, this is the point of harvest, similar to what we had in the last one. Measure corn at fair value less cost to sell, which in our case here will be 110 million times 0.98, because the market value has gone down, which is 107.8 million. And then the good student will say there's actually another standard that's relevant here as well, because it's going to be transferred to inventory. IAS 2 is now also relevant in March 2019, as once the corn is harvested, it becomes inventory. But you're shown we're not looking for big essays here, but we are looking for you to be able to show your knowledge of the key standards. What does IAS 41 say? What does IAS 2 say? And how will they link together? So that's part 1. So you say 1, just do a label for the examiner, and then you have 2. And then you have part B, the journal entries. These are relatively straightforward. Well, to recognize how you should measure the asset, so during 18 they planted the crop. Well, you're going to measure the crop assuming for the first time. You're going to debit biological asset. You're going to credit, in this case, SOPL. 117.6, 117.6, and that's million. Now, you might argue here, well, hold on, that's the full value. Sure, there's a movement, but we're assuming here that there was no other figure put in already. If there was, for example, costs related to planting the corn, then you might have some biological asset there at the start. But generally, you initially recognize the biological asset. You recognize that it's fair value less cost to sell, which is the 117.6 million. So we have no other base starting points. We assume that's the initial one, and you put it straight into the P&L because that's a pure gain. Now, it's probably not the most realistic because there might have been some costs to plant it initially at the start, which you'll have to adjust for. But here, that's the figure we're given, so we can assume that's the correct journal. Then when we get to March, the following year, we have to be a bit more careful because there's a couple of steps involved. You can do this as a single journal. We'll do it in 2 steps. 1, fair value the corn before harvest. So we're actually going to credit the biological asset and debit the SOPL, the difference. It's going from 117.6 down to 107.8, which is a loss of 9.8 million. So we fair value it first. We actually fair value it down, which is the opposite of what we had. And then you transfer to inventory at point of harvest. So again, this is hopefully you're going to manage this based on the last question. At that point of harvest, we're going to credit the biological asset. Be careful, you're going to credit at 107.8 because that's what it's valued at once you fair value it down. And you're going to debit inventory 107.8 million. And that's now your implied cost when you're using IAS 2 going forward. So again, it's a 2-step approach as we go before. And that's your inventory now remains at 107.8 until it's sold or until you have to do an inventory adjustment if the value continues to decline. So not a million miles away from what we did in question 1, but we're trying to hammer home that concept of how to value a biological asset, how it relates to IAS 2, but also as well the link in terms of the journals of how to prepare them. Because a lot of students are able to talk about it, they learn off the standard. You must be able to give journal entries as well. I don't expect an exam scenario to give me a narrative, so you don't have to give me the little narrative underneath the journal. If you give me the key journals and they're correct, you'll get your full marks. But you will be asked for journal entries in the exam in May. So it's important that you know them, not only the journals, but you'll be like this, you'll be asked to reference the appropriate standards and explain why you're doing it. It's one thing knowing journals, another thing articulating why you're doing a particular calculation. Okay. And the last question we have today then in this particular standard, our tutorial, is just a small question on IAS 2 inventories. So have a read through it again, pause it and see can you make an attempt at it. We're asked 2 things here. Determine the correct closing inventory to be included at the end of 2020 for Gryson and provide the necessary journal entries. So make sure you give both requirements. So this is a particular issue in IAS 2 where we're told that the closing inventory was valued at the 4th of January and the closing inventory was 210,000. Now the difficulty here is that's of course not the year end, 31st of December. But this is a common enough practical issue where you may not be able to get access to the warehouse, or you may not have enough staff at the 31st of December to do an exact stock count at the exact date. So what you can do is you might do it before the year end, and what we call it is you roll it forward, or you might do it after the year end, such as we have here, and you roll the inventory count back. So essentially, you take the date of when the stock take was done, and you reconcile by adjusting purchases and adjusting sales to get back to what date you want. So we want to know the closing inventory not on the 4th of the 1st, 21. We want to know the closing inventory on the 31st to 12th, 2020. Right, so there's only a couple of days, but there's a couple of transactions that have happened which would have moved inventory in the meantime. This is an important thing that we understand, and that's something I would have mentioned if we come back here. We did this in terms of slide 27 and slide 28 in your slides. So go back and look at that recording if you are not sure and you're really not sure where this question is coming from or what it means. All right. So the first thing is on the 2nd of January, inventory was sold for 30,000 to a credit customer. Right. And then on the 3rd of January, they purchased inventory from a supplier for 40,000 on credit and it was delivered on the same day. Both of these were accounted by the bookkeeper in the 2020 accounts. And Gryson makes a markup of 25% on its sales. So the key thing we want to know is this is post-year end sales, post-year end purchases. So what I want you to think about is, think about the sales. These sales happened on the 2nd of January. So it means that inventory would have been there on the 31st of December, but it wasn't there on the 4th of January. So if we're reconciling back, we need to add back in those post-year end sales. We're not going to add back 30,000 because that includes some profit. You want to know what the cost was. And if the markup was 25%, that means the sales revenue is 125% of cost because you mark up as a percentage of cost. So your post-year end sales, the cost of that was 24. So think about it. That inventory cost 24,000. It was sold on the 2nd of January. So when you came to count the warehouse on the 4th of January, it wasn't there. But on the 31st of December, it would have been there because it wasn't sold until the 2nd. So you add back this as would have been in inventory at 31st to 12th, 2020. And you don't add back the 30,000, you only add back the 24 because we measure inventory at the lower of cost and NRV. The cost here is the 24. Purchases are the opposite. You've purchased goods on the 3rd of January, so that means they would have been in stock on the 4th of January and included in here. But we know they wouldn't have been there on the 31st of December. So take away as would not have been there at 31st to 12th. And because the purchases, you can take off the 40,000 directly. Because when you buy inventory, that's the cost. When you sell, you do cost plus a profit, your margin or your markup. Whereas when you're buying goods, that's the actual cost of the inventory. So your closing inventory here at the 31st of the 12th will be 194,000. That's what we call a rollback procedure. You're rolling back from 4 days after the year end and adjusting for any post-year end sales or purchases. Similar logic that if it happened maybe on the 26th or 27th of January. So this example did a rollback as well, but you'll see some of the past exam questions and the question pack will have done a roll forward, where they roll it forward from maybe the 27th, 28th of December to the 31st of December. And then you might do the opposite of post-year end sales, post-year end purchases. So it's important to understand that logic. That the first one is the correct inventory is 194. The journal entries, there is a couple of journal entries here. First journal entry is to recognize inventory. Debit closing inventory at the year end adjustment, credit cost of sales, 194. So you always bring in inventory at the year end. You debit closing inventory, which is a current asset in the statement of financial position, and you reduce your cost of sales, which is a credit to the cost of sales. The other thing we're told is this sale and purchase, which was after the year end, was recorded in the accounts for the year end, and that's not correct. Error to include post year end sales and purchases in 2020 accounts. So you need to reverse them. That's something a lot of students might have picked up on. So you need to debit sales 30,000 and credit trade receivables, because we're sold on credit, 30,000. You also need to credit trade payables, because it was bought on credit, 40,000. So that should be debit trade payables. You're reducing trade payables down, debiting a liability. And you can either here, if you wanted to say credit purchases, or you can credit cost of sales directly. Either of those would have been acceptable. So what you're saying is it's not correct to recognize a sale in 2021 or a purchase in 2021 in the year-end 2020 accounts. But did people pick up on that in terms of providing the necessary journals? A lot of students might have missed those and missed a couple of valuable marks. So watch out for that in the key dates and the information given in the question. So that was a shorter one in terms of IAS 2, but an important practical procedure around a rollback, where you have an inventory count after the year end and you're trying to reconcile back to what was there at the year end, because we need to know the closing inventory at the exact date. And that means dealing with post-year end purchases and post-year end sales. Okay, so that's the finish of the week 6 tutorial, looking at IAS 41, agricultural assets, and also looking at IAS 2, inventories. And remember, there's plenty of other questions up on Loop, looking at the question pack for that week section as well.